Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of Elder Talk. With us today is, I think it's safe to say, Jill, our most popular guest.
I think you're right.
Now, we do make a habit of having back the people who are really popular with you guys. We hear good things, we get favorable emails, etc. He always talks about topics that are of interest, about financial matters, how they affect, your savings today and your plans for the next 5, 10, 15 years and beyond. And a lot of his clients are older clients. So he has this perspective in helping people plan who are 60 or 65 and older. Introduce our guest, Jill.
That would be the one and only Todd Oetken, financial advisor and certified financial planner of R.W. Baird. Welcome back to the Elder Talk show, Todd.
Thanks, Joe and Jill. Appreciate you having me back.
And now I should say Todd comes to us from Louisville, Kentucky, and he's occasionally been out here and been in studio, but he's busy, and we find that this works very well now that we're doing more of these remote interviews.
Yeah. And Todd, you're doing something interesting today.
I am. I'm actually, after this call, I'm going to give plasma. I had COVID. I actually had the virus about 3 months ago, and I got tested positive for the antibodies. So the Red Cross has asked me to give plasma so they can help other people. So I'll be doing that. It'll be a first for me. I'm sure a lot of your listeners have probably done it in their old hat at it, but to me, I'm still a little worrisome about it.
Well, I applaud you because you're doing your part to fight this virus.
Yeah, you might send a test tube of that plasma out this way.
Yeah.
Yeah, there might be. I guess that works. Apparently, that's the theory behind this. I'll resist going down this road, but apparently, by using the blood that has the antibodies in it, injecting that into certain patients, is it not somehow therapeutic?
Yeah, that's what I understand. It's more of a treatment, isn't it?
Yeah, and I think it's a treatment more for people who are pretty far down the road, who have, for example, a serious condition.
Those who are hospitalized, yeah, of course.
So anyway, let's shift gears and let's talk about this crazy, crazy time. It's true that people tend to always talk of their days or their era or their period as being an important time in history. We all want to believe that about when we lived or what's going on for the time being. But I think that we can make a pretty good case against it. I mean, we were right up there maybe with the American Revolution. It's just extraordinary times, and it really makes you have concern about the future of our nation. It's not inspiring at all, at least for me, and I suspect for many of you.
Scary, I think, for a lot of folks.
It's scary. And for people who are over 60, 65 years old, they're trying to plan for the balance of their lives.
Right.
And right now, we don't even know for the balance of the year exactly what's going to happen. So we want you to weigh in, Todd, about this disconnect, seemingly, between, on the one hand, a stock market that just thinks that we're headed to paradise, and on the streets where we've had riots, we've had this quote-unquote insurrection attempt at the Capitol.
Mm-hmm.
We have these two stories of what's going on presently. And on the side of those who would express fears and concern would be those who point, of course, to what we were talking about at the outset, COVID. So we have a pandemic unlike anything we've seen in 100 years. It did last almost 2 years. So I was skeptical originally that this would do that, but it's turning out that it's going to be around for probably end up being extinguished this year, I think. So it'd probably be close to 2 years. When you look at these factors in the world and then throw in for good measure what's going on with China and Russia, I mean, they haven't been this militaristic, I think it's safe to say, since the Cold War. And that means since Beijing decided to open to the West in the early 80s, and then, of course, the wall comes down, the Berlin Wall comes down, 1990 or so. And and since then, it's safe to say we've probably never seen this much tension among the superpowers. And they're sort of unrelated. I mean, China's doing its own thing, which, it has this hostility for the West, and much of it is related to our financial system and the conflicts over trade. So it's funny how money, assets, and markets drive so much of what happens in geopolitics. But then on the other hand is Russia, and Russia seems to be marching to its own tune. It doesn't seem to be working in alignment with China, at least not deeply, if some. And Russia has its own agenda, and its neighbors now. This article was in the Wall Street Journal a couple of days ago. Sweden, that has always taken pride in being unaligned. It very scrupulously did not align during the Cold War, and now they've actually invited U.S. specialists to do troop maneuvers there and to train their troops, and they've increased military spending. All these countries, Japan's increasing military spending. Throughout that crescent in Southeast Asia, they all have concerns, particularly for China and for Russia. So it's a crazy world. And so I'm setting you up, Todd, to give us some light here as to how we should plan our futures in this environment.
The technical term for all of this is it's messed up. There's no question about it.
I remember that term from economics
it is
in college.
messed up.
Yeah.
It certainly is.
But what we do know that we've been through things like this before. We've been through a depression. We've been through the swine flu. We've been through the Spanish flu. We have been through, the United States has been through all of this. Now, maybe not the triple whammy that we're going through today, but we've been through these things. And our economy is very resilient, and it is based on consumer spending, and we're going to make it through this. So what does it mean to someone who's retired? That's the biggest thing, because those are the ones who don't have a reoccurring income that they can weather any of these big storms. So if you just retired, or if you are planning to retire in the near future, having a good financial planner is imperative, because they will help you manage the emotions when you're dealing with this market. They'll help you decide how much money you're going to need in retirement. They'll help you realize that, hey, do you have too much debt? Are your expenses too great in order to weather certain storms? And it'll help you develop a portfolio that would have you enough cash to weather downturns in the market and still not hurt your portfolio. So right now is a great time to have a very good financial planner in order to weather these storms. But let me tell you, I'm an optimist, and I do know, I'm very confident in this, that our economy is going to weather this storm. And if you actually go outside and look around and with your own eyes see what's really happening in your little area of the world, you will see that people are opening the doors for people. They're saying thank you. They're helping people pick stuff up off the ground. They're cleaning up their areas. They are going around their life, because the world is full of really good people, 99%. It's that 1% we keep hearing about. But other than that, if you open your eyes, you see that things are going pretty well.
Now that is a inspiring perspective.
It is.
Now, I have to tell you that it's a little contrary to my own, but I need to hear that.
I do too.
I need to hear that, because I often don't see that goodness that you describe occurring. And I know you're right; it is happening across the world. And I've seen during the coronavirus, this whole epidemic, people behave in more considerate ways, quite frankly, than they often do. It's funny, you watch the news and you think humanity has become just hostile and violent. And yet you go in grocery stores and you see some things like that, of course. But if you look at it proportionately, the vast majority of people have become more considerate, I think, during this period.
Yeah, and you can look back at after 9/11, we saw a lot of that.
Oh,
with
yeah.
people reaching out to their neighbors, and there was that goodness and humanity that we saw. Todd, I'm curious, what do you think it's going to be like for the big tech companies this year? I mean, we're seeing a lot of conservatives leave Twitter and Facebook because of all of this political fallout.
Facebook is going to have a little battle anyway, because, they keep talking about breaking it up. It's gotten too big and it's gotten too powerful. So that's something they're going to have to deal with. But they still have over 2 billion followers, and their market share is, unsurpassed, and they still have great marketing dollars. So, but just like the tech bubble in 2000, you don't put your whole portfolio in tech. You put a little bit in there, and you always make sure that you're diversified. And then if one company doesn't do so well, your other ones are going to do well.
So it doesn't require that you be able to answer correctly Jill's question. And although I'm curious as to what will happen, I still like an answer that doesn't hinge upon you being a prophet on this particular subject, because you can't be. Nobody can be. And I think the right answer is, as to many things, is we're not sure enough to make an investment or to commit a substantial portion of our portfolio. So what we do is we allocate it, we sprinkle it around different things. I think that I think the world's going to change in terms of this sort of autonomy that's been enjoyed by the online giants. I think that for Google, Facebook, Twitter, I think that they've operated with impunity. This, Section 230 that is being considered. I think that they've enjoyed something that very few companies have, and that's the freedom from liability, not being held responsible for anything that's said and the consequences of those statements, as normally a business would be held responsible when they participate in a communication or a transaction that results in people being harmed. So I think that this sort of privileged position they've enjoyed is going to change.
Yeah, we're going to see more competition, and we already have in recent days with, Cloud Hub, Parler. I heard of another one called Telegram, I think.
Yeah, but is Parler going to make it back? I think they just need their servers. What happened was Amazon shut down their servers.
Right.
And they need like 30 or 40 servers at least, and there'll be a few days locating those. Do you know any more about that, Todd?
No, I haven't heard anything about Parler.
Yeah, it's a conservative counterpart to Twitter.
Yeah.
And because naturally conservatives go on there, they're saying things that aren't approved of by the folks who edit most of the big tech companies. I'll say the Silicon Valley crowd. And since they disapprove of pretty much everything that would be said by conservatives, they're going to characterize it as hate speech or speech that's contributing to violence. So Amazon concludes that they're justified in completely shutting them down, effectively saying, you're off our servers. With 24 hours notice. I think they had 24 hours notice.
Well, so it's good to have that competition. I hope they get back up, and I hope they can voice what they feel is appropriate, and people can listen to both and make their own decisions instead of someone making these opinions and decisions for them.
So let me push back then a little bit about, or I say push us along, in terms of thinking about how to invest in the balance of the year. Let's assume a person listening is 70 years old and that they can't afford to participate in another decline that ultimately recovers, which I think all of us on this call believe that whatever happens, there will be a recovery on the other side. It's just a question of having a sufficiently long horizon to be able to participate in the recovery and it not occurring too late. So for that person whose horizon is closer than many, should they be a little concerned about staying in a market where it's so frothy, where these PE ratios are so high? The market hasn't been growing at the pace of Bitcoin, but still, it's gotten pretty frothy. Shouldn't this be distrusted?
Once you retire and you've created a portfolio, you've already determined how much risk you're willing to take. And the way we measure that is we determine how much of a portfolio should be held in cash, very safe and secure investments. And when the market goes down, we can use that cash to support our lifestyle until the market comes back up where we can sell the other assets. Then we have so much in bonds and we have so much in different type of equities. So, what has happened this last year, because we've had such a run up in the market, let's say that the average investor had a 70% in stocks and 30% in the cash and the bonds. Well, because of this nice run up, maybe they're 80% now. So they just need to rebalance back to what their portfolio should have been, which is going to be that 70-30. So they'll be selling some of the stocks and buying more of the CDs and the bonds and putting in cash. And that way, as the market will go down, it goes up. That's the only guarantee that we have in investing in the market. Then we would just use that cash and we'd have that available until the market recovers. And I'll give you a great example. Back when the market took a big dump in March, I had an investor who said, hey, now my bond portion of my portfolio has risen to 50%. It was 30, but because of the stocks went down, my percentages are off. We're ready to rebalance that. Well, we took that 20% that was in the bonds that should have been in the stocks, we bought in. Well, because you're buying in at that lower price, because we rebalanced in, that portion of their portfolio was up 40% from March. And again, you do that when the market goes up. You can do it when the market goes down. The challenge is, as the market's going up, you don't think it's ever going to go back down. And it's really tough to say, no, pull that out of the market and put it into this cash where I'm not going to earn anything, because you see that portfolio going up all the time. But as long as you're disciplined, then that usually works.
Okay, I want people to understand the point you made, because that's important. You're saying that, for example, if you decide that I want 30% in stocks, we'll make it easy, 33% in stocks, 33% in bonds, and 33% in cash. Now, stocks and bonds often move in opposite directions, so people should know that. So if, for example, the market changes to where the bond prices have gone up, so that means yields have gone down. So let's say if you were to total up the total value of your investment, that it turns out that because bonds have gone up, you no longer is it just 33% of your total investment. Because it's gone up in value, maybe it's become 40 or 45. And what you're saying is that's when you have to have the discipline to sell off that part enough to get you down to the 33% that you want to be. And then, in all likelihood, stocks have gone down quite a bit, which is why that happened to begin with. And you take that money and you end up buying the stocks while they're down. So there's a logic to it. So that, in your example that you just gave. So I want people to not miss that. So you do end up catching the market. Though you're not trying to time the market, what you're doing is just rebalancing your portfolio to keep your percentages in different types of areas of investments. But the effect of it is that you're kind of timing in a way, because you're bringing money out of what's high and into what's low.
And you're adjusting, I guess you could say, to the conditions of the market.
Yeah. So when the market comes back, you're in a position to enjoy much stronger benefits. But then you have to rebalance again, when it's the stocks that have become more than 33% of your total portfolio.
And Todd, I'm just curious, what are you hearing from your clients during this very volatile political climate?
Yeah, I think typically, especially older clients are fearful.
More so than they were, say, back in March when the pandemic was declared.
Yeah, because they listen to the daggone news. If you quit listening to the news, you wouldn't be as fearful, just because the fact is, if you, again, as I said in the beginning, if you go outside and really look and see what's going on, nothing's really changed in your own little environment most of the time. But if you listen to everything going on in the entire world, gosh, it makes you think everything's falling apart. So some of the clients are fearful, but that's what part of our job is, to manage the emotions. And that's such an important part of our jobs, and make sure they understand that, we have a plan. We didn't just throw money into the wind and say, hey, we're going to invest it. There's a reason why we invested it for them the way we did it for them.
So, and I get the idea of not so much trying to be a stock picker as simply trying to allocate your funds so that you're hedged, and whatever happens, you end up being okay. But what about the person, though, who's looking at particular industries and thinking, this seems like really a ripe opportunity to jump in? I was saying to people something I didn't act on, which I notoriously do this when I'm talking about investments, is I'll talk about things that I think are just marvelous, but I rarely ever go out and follow up on this. I remember when the cruise lines were they were just devastated. They're still down, I'm sure, but it looked like they were going to file bankruptcy. One did. Which one was it? Was it Carnival?
I don't
Anyway,
know.
so they were just devastated, and people were saying there will never be cruising again. So to me, that would have been an example of an industry where someone might have intelligently gone in and bought it at under $10 a share, I think, as it pertained to, I think it was Carnival. But there were like 3 major cruise lines in the world, and Norwegian, I think, is another one. And you could buy them, at 80% off at one point. So can you think of things today when you look around you and where you would say, yeah, it's safe for people who are wanting to take some money, risk it, choose a particular industry and drop in and purchase those? Do you see those opportunities now around you?
I don't think I'm qualified to answer that question because everybody's going to be a little bit different. But if you want to talk about generalities, I mean, gosh, the hospitality industry has been devastated. And usually when an industry has been devastated, but you know that industry isn't like the buggy whip, where it's actually going out of business. You know that
Yeah.
it will recover. You have to have stamina to stick there until it does, which may be, 3, 4, 5, 6 years.
Now,
Uh,
that's a good example, but when you say hospitality, you're talking about hotels,
Hotels, gaming.
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 But now I have to admit, gaming has really weathered the storm pretty well because of the online gaming on some of these. So I don't want to mention individual stocks because that's unfair to your
Right.
listeners.
Yeah.
But gaming hasn't been hurt as much as hotels, restaurants, cruise ships, anything kind of like that. It probably is a good place where it has been down. It's still down. Until COVID really is under control, it probably will continue to be down. But you have to find companies that are cash rich, can weather this storm because they have a lot of debt and they have to have that cash reserve in order to pay that until the revenue start picking back up. So you have to make sure you pick the right companies if you choose to do something like that.
One thing I like to do is to look at what are sort of lead indicators. One place where you can get some indication of what the best and brightest are doing, the ones who've hired the analysts from MIT, those quants and whatnot, that really pour into the economic data and come up with these strategies. And you can watch what they're doing and in some cases just follow along. And one example, of course, after 2008 was the decision for these huge hedge funds, BlackRock or Blackstone, you were talking about billions of dollars here, went across America and became the largest holder of individual homes in America. I mean, the largest number of homes. They would go through neighborhoods and they would have representatives in cities across America and just drive past a house and decide whether to buy it without even going in it based on just rules of thumb. They knew how many bedrooms it had, how many bathrooms. They could look at the exterior and then they would call in and make an offer and buy it.
Housing investors, are you referring to?
Yeah. In other words, they make it their job to identify these industries or these pockets of incredible opportunity during crises or in the aftermath of crises. They anticipated that with houses across America selling at 60% of their previous value, in some cases less, that they just go in and buy them all up. And that if they have the patience, they can rent them out. They wait 5 to 6 years, which is normally the plan on many hedge funds, and then they plan to sell. And I can tell you, they ended up being incredibly profitable.
Right.
And the same thing is happening now. There are these hedge funds, and some would call them vulture funds, where they've been created specifically to go in and buy, for example, hotels, or to go in and buy
airlines. They've been pretty devastated too.
Airlines, yeah, definitely.
They've been hit, but also commercial real estate. So they're going across America buying these certain subcategories of commercial properties where they think there's potential opportunity for it to come back, and they've been really, really beat up. So it's when most of the market is saying, houses are in trouble, or in using the 2008 example, or hotels. People are not going to travel anymore. Businessmen will never go on an airplane again. They'll never stay in hotels. Those who are saying office buildings are going to go dark because you're not going to have anybody working in an office. So people during crises tend to go over the top and they overreact. And if you follow what these funds are doing, you can just follow in tow, and in your own small way. You don't have to invest in those funds, although that's a possibility, but also in your own small way, you can choose to participate in that type of investment through whatever opportunities exist for that particular investment. But you're aware of some of these funds that are forming to pursue these really damaged investments that may, in fact, come roaring back?
Yeah, for sure. I don't know any specific names, but yeah, that happens every time there's a catastrophe like this.
And
I agree with you, Joe.
Yeah.
I think that. I mean, you have to have the forward thinking though in order to see what the future is going to be, and that's when everybody else is running, and these guys are running the opposite way, trying to buy what they're running from.
And I think measuring the mindsets of people, of where they're going to be. I mean, you hear so many people saying, I am so sick of this virus. I'm tired of living in a bubble. And at some point, they're going to go back to these industries. They're going to go back to traveling, flying, going on vacations. I think that's, pretty clear.
It's human nature.
It
isn't
is.
I don't think our nature is going to change. And if we look at how did the human beings behave in 1918, 1919, well, we went into the Roaring Twenties. They were dancing and drinking and partying, and it did not seem to be a culture in which people hunkered down and gave up.
Anything but. They were not living in fear.
Yeah. It was the party's on for the next 10 years, and by the indications that we're seeing now, I can imagine lots of Americans today reacting that way. So one thing I should mention, though, is that I realize, Todd, that you can't, given the ethics and whatnot of your field, that you're not going to advise particular companies. So people should know that. So let me ask you this. As people are listening to us, they're thinking, okay, what Todd recommends as a foundational principle, where you allocate your money in these 3 or 2 or 4 different pots, and you rebalance. Yes, that sounds rational for the bulk of my savings. However, I still have this penchant for looking for opportunities myself and taking some portion of that and doing that. So, first of all, does Baird do this? And if Baird's not available to them, are there financial managers that they can go to and say, I'm interested in a particular industry, and this would be the way I personally would approach it. I wouldn't want to go and research, for example, the cruise industry, or I wouldn't want to go research the hotel industry. If I believed in it, I'd want to call my financial advisor and say, I want to throw some money in this particular industry. And can you help me figure out what are the best companies or what is the best way to do this? Do you have clients who come to you with those sorts of specific requests?
Yeah, we do, and we can do that. We always make sure that we're not soliciting that, and we have to make record of that, saying, hey, we're not the one saying, hey, come do this, because it is risky. But as long as the client understands it, and they're saying, hey, they're giving us some direction, we'd be glad to do some of the research for them and say, hey, if you were going to do this, these are the top companies we would suggest.
And this is something that distinguishes, and correct me if I'm off base here, Todd, but I think this is something that distinguishes a financial planner from a stockbroker. You have to remember, if you have a stockbroker, they only make money when you're buying stocks. Now, I'm not saying that necessarily means that they're going to give you bad advice. I mean, there are honest stockbrokers out there. But you have to know what the incentives are. The incentives are for them to engage in transactions. And I do believe that a stockbroker will try to engage in transactions that help you achieve your goal, of course, but they still have to have you engage in transactions for them to make money. So it's a whole different perspective if you have a financial planner. Financial planners generally charge you either a fixed annual fee, or they'll charge you hourly, or they'll charge you a percentage of your total portfolio, whatever you do. In other words, they say, if I'm managing $1 million for you, I'm going to charge you 0.5% or maybe 1%, whatever it might be, per year to manage your portfolio. So the wonderful thing about that is you can go to those people and you can talk to them, the financial planner, and they don't have a horse in the race of whether you turn around and buy some stocks that day. Whereas with many stockbrokers, there is that incentive, and I just think it can sometimes cloud the stockbroker's perspective. Tell me if I'm right on that, or make your comments on that, Todd. I'm curious to hear what you think.
Yeah, there's different levels of fiduciary of responsibility, and on just someone who's picking stocks for you, they have a suitability responsibility, meaning that the investment has to be suitable for you, but it may not be the best choice for you. It might be the best choice for them, but it's suitable. A financial planner has a fiduciary responsibility, meaning that your best interest always has to be the number one reason they're making a decision for you, and which means they may make less, but you will make sure that what you are recommended is in your best interest every single time. That's why we would definitely have to ask for you to say, hey, we didn't solicit this. You're making this on your own free will, and we're not recommending it.
So it does matter how they get paid, and it's perfectly acceptable for a client to ask that, how you are getting paid.
Yes, very much so, Jill. They can do it. Like on most financial planning associations, they will do a percent of assets, or like Joe was saying, so much per plan, or so much per hour. But what we do is a percent of assets.
So when a new client comes into you, do you automatically tell them how you make your money, how you get paid, or do you wait for them to ask?
No, it's a requirement. We have to tell them exactly how we're getting paid. And if there's any, which there isn't, 99% of the time, there's not like any hidden fees anywhere. But if there were, we would have to say, and you might see this 12B1 fee on this mutual fund, which there isn't in what we do. But we would have to divulge every single way that we get income.
So how did this happen, that there's a fiduciary standard that's applicable to financial planners, and apparently the fiduciary standard is not applicable to stockbrokers?
It has always been for a CFP. So once you get your certified financial planning designation, you become a fiduciary. And then the regulators also started putting you as a fiduciary if you were managing retirement plans, because they had some dishonest things going on in there. And then about a year ago, they started adding just normal investment advisors as fiduciary. Now that's been blocked some.
Yeah.
Not everybody has to do that. They kind of did away with it, but I think President Biden may bring that back. But the fiduciary is a higher level of standard of care for your client. So when your client is dealing with someone who is a fiduciary, they have to understand by law their best interest has to always be taken in consideration before a decision is made.
Most people don't understand what is the difference between being a fiduciary and not being a fiduciary, because they assume that anybody who they're getting financial services from has to act in their own best and in the customer's best interest. But people need to understand that this is a huge, huge deal to be tagged as a fiduciary. A fiduciary is somebody who has this solemn level of trust. It's the highest level of trust in the legal as a term in the legal system. So whenever you're tagged as a fiduciary, you're entrusted to handle money in the absolute best way possible, and it has to be entirely selfless. So a salesperson, stockbrokers, really fought back when it was suggested that some segments of the industry was going to be affected by this, because their point was, look, we're salesmen. I mean, of course we're going to try to sell people things that help them. We're not going to say things that aren't true. So yeah, hold us to a standard where we can't deceive. We can't mislead. We can't knowingly have somebody invest in something that that is not good for them. But, gee, don't hold us to a fiduciary standard, because they understood that it's a step above all those things you normally expect from an honest salesman. So if in fact the Biden administration goes down that road, I know that many in the financial industry who sell products, they really believe that it's going to make their lives much more difficult and maybe wipe out some of the industry.
It will really hurt the smaller investor, I believe, because why would you take on that added responsibility for someone that has less than $100,000? The reward doesn't really meet the risk that you're taking if that happened.
Yeah, and people want them to be able to tell them what they think. So some may see, oh well, nobody can push a product on me that maybe the salesman just needed a commission that day, so they recommended something that was okay, but it wasn't the absolute best thing for me. Like the duty of a parent to a child is a good example, or a duty of a guardian to a child legally. When you think of that selflessness that's required in that relationship, that's what fiduciary means with clients. So it's been applied to you guys, certified financial planners, Todd, for some time, and you're used to it, and it doesn't threaten you because, the way you're compensated, there's no incentive for you to do anything but the most conservative and safe thing. But I can see a downside of the fiduciary restriction. I can see where it really confines somebody who wants to give advice that they believe and they're reluctant to do it. Like in our example, where maybe you really believe that your client should be buying into hotels. Maybe you know enough about that industry to where you think it's a marvelous idea and you would do it with your own money, perhaps. But if things go south with that under a fiduciary standard, you would probably be giving testimony in some sort of hearing, and somebody will ask you, well, isn't it safer to have diversified that investment and put it in a stock exchange or an index such as NASDAQ or Amex or something such as that? And your answer would have to be, yeah, that would have been the safer thing. And suddenly you're tagged or held liable for losses just because it was possible to choose something more safe. But your client didn't want something more safe. At least at the time they didn't.
Yeah, they wanted that risk.
Yeah, they wanted the risk at the time. It's funny, when you want risk and it doesn't go the way you want, then you want somebody to pay you
blame.
back.
Yeah.
Right. That was very well put, Joe. That was very well put.
So you agree with that the fiduciary status can impose unwanted restrictions? Completely.
Yes, I do.
So I do think that people, in following, for the most part, the advice you were talking about, but yet many people would want to be able to take some investments to the side. So how do you do that, though? You said that if somebody says it to you, brings it up to you, that they want to invest in something other than a safe funds, or in addition to the safe funds, I should say, that you can then give them advice?
Well, we can't. It's really not advice. We would give them information at that stage. We would make sure that we document that they're asking for the information. We're not recommending anything, but we're saying, hey, we'll give you enough information so you can make an educated decision if you want to make this type of investment.
But you get clients that say, come on, you're my financial advisor. What do you think I should do?
Yeah, I can imagine that's.
Yeah.
I would want to press
tough.
you.
Yeah, it's tough because you really can't do that. We can kind of give an opinion, but we can't really. It's a challenge to do that. And because it may not be the best choice for them, but they want to make that choice.
Well, that really, though, if you think about it, Todd, that's kind of become the assumption in marketing online. When you look at all of these websites that have gone to even fee-free, I think that who's the major website? I'm drawing a blank.
Just Schwab?
Schwab is probably the biggest, or one of them. Mm-hmm. Didn't they announce some time ago that they were eliminating fees entirely?
Somebody did, and I thought, how do they do that?
Yeah, and I'm told that the way they do it is they make enough money from the return on the funds that you keep parked in your account between transactions. So if you open an account with them, you're going to stick $100,000 in it or whatever the number is. And there'll be periods of time when you have money in that account sitting, and that what they earn from that money is theoretically enough to make a lot of profit over hundreds of thousands of accounts. So I guess then what it's become is that it's across the internet is the assumption that you have individuals making their own decisions. It's not through an intermediary, such as a stockbroker for the most part. People are encouraged to do their own research on these sites, form their own opinions, and hit the buy button. And I think people are doing that en masse across the market. Was it Robinhood? Robinhood was one of a very popular website where people are going out and they're doing day trading and whatnot. And it's a Wild West, meaning people are on their own. They have lots of material thrown at them. They're supposed to read this and understand it, which I'm very skeptical that they understand it.
Right.
I'm skeptical that they read it, number one. But if they did read it, that they understood it. They're charging into this investment world, which has all these complexities and whatnot. But generally, it's assumed that they're on their own. So I do think that, quite frankly, you're on the right side of the trends where you're offering a service in which people who want to have a conservative, orderly strategy, they can turn those funds over to you, and any portion that they want to, I'm reluctant to use the word gamble, but any funds that they want to make riskier investments, they can even do that on their own, can't they?
Yeah, and we have some clients that do that. They have their little fund money, and they try to beat us, and it's kind of a little game that they play.
Huh. Well,
sometimes they do, but they don't tell us when they lose. They just tell us when they win. So
yeah, it's like people who buy lottery tickets, you know.
That's right. But going back to that, Joe, let me make one description that I think is important. You have the internet, and people can go out and buy whatever they want. They can do their own research, but you still need somebody to manage your emotions. People are an emotional type of decision maker. And there's so many times that I see investors make mistakes. It's through the emotion part of it. You're selling when it's going down. You're buying when it's going up, all because you get into the hype. And once the hype's there, then the opportunity has already been gone, and you need to get somebody to talk you off the bridge.
That's a point worth making. Many of us are not humble enough or objective enough to acknowledge that, but the fact is that very few people consistently beat the market. That's a fact. Now, I won't go as far as modern portfolio theory, which is a very popular theory in academia in the graduate business schools across the country, the best business schools. It's been long assumed that people, in fact, could not beat the market. I think that's starting to lose a lot of currency. It was taught for probably 30, 40 years. And in the last decade or so, I think many of even the academics are starting to concede that, there are a few people that can or that do have a track record that you can't regard as simply chance. So the idea is, just so people understand how this theory is not as absurd as it seems, because you may be able to think, oh, I know of someone, or I read of a fund, for example, say a mutual fund, that consistently got these incredible rates of return over 10, 15 years. Well, here's the way that is explained as an analogy. If you have thousands of people who are flipping a coin, you will have a certain number of those thousands of people that over 15 flips will have all heads. You may say, well, that's very improbable, and it must be rare. It is improbable and it is rare. But when you have thousands of people doing it, guess what? It's statistically probable that you'll have several at least, and probably significantly more than several, who will end up with 15 heads or 15 tails. So the argument against those occasional people who do have a track record of great success over 15 to 20 years is that if it were random and the market essentially incorporated all the available information, then you would expect to have some people who had these perfect records simply by chance. If they had been chimpanzees running these funds, the theory goes that, you'd have some that had incredible rates of return for 15 years, for example. So this is called modern portfolio theory, and it just says that nobody can outsmart the market very long. So now I think that's not taken as the gospel anymore. Now even the academics are starting to concede that, we think that the evidence, when you look at it, there's enough people who, for various reasons, which I can't explain, they do seem to be able to outsmart the market pretty consistently. It doesn't mean they're perfect, but it means that it's happening at a level where it's now believed it's not simply that chance. So the whole idea, though, is that it may be possible to outsmart the market or to get a rate of return better than the market, but except for those very rare occasions that we've just talked about, the bottom line is you're not going to outsmart the market. And rather than try to look for those few examples like the Buffetts of the world who do seem to do that, the probability is that if it's a race between you and, for example, Todd, your firm, and one of your clients, over a period of a number of years, you're going to beat your client every time. And I just think clients are not willing to concede that. And that's the reason the Schwabs are doing so well, and Robinhood and all these other online accounts, is that people have this belief that somehow they're going to beat the market. But the evidence, even those who concede that it's possible, it by no means suggests that any of these people we're talking about are ever going to consistently beat the market, period.
I agree completely. At the end of the day, I truly believe this, being in the industry as long as I have, that a good portfolio of very good stocks that, you really go in and look at the management and look at their industry and look at how well they treat their clients and their customers. If you buy a good basket of 20, 15 or 20 stocks and just put your money in there, let it sit there, only change when something changes about the company, still get that dividend every month. When you're retired, again, it's going to be more conservative than someone that's 20 years old or 30 years old, but you will always do better in the long run, in my opinion. And if you're going in there and trying to buy this guy and then you figure out when you're going to sell it, you buy that one, and going back to try to beat the market every single day. Just invest conservatively, invest, with the thought that there's a portfolio of risk involved here, and you stay with that portfolio and weather these storms. And when we come out of the other end of this, everybody's going to be fine.
And one other thing, I know that your time's limited, Todd. One other thing I want you to draw attention to is when you advocate, instead of trying to pick stocks, but focusing on this strategy you described, where you choose these large areas of investment and you keep rebalancing. There is an approach that's become popular in recent years, and I think it's called targeted investment. Do you know what I'm talking about?
I do. Mm-hmm.
Can you talk for a minute about that?
So the target investment, where you would see different weaknesses in a certain industry, and you say, hey, I feel that that's going to be a depressed industry, and that's where I'm going to really focus on maybe this ETF that focuses on that industry. So you don't have to buy individual stocks in that industry. You have a portfolio manager doing that for you. And so you can kind of, prefab your investments to where you can take advantage and be a little more risky on that portion of it. And let's say it's 5% or 10% of your portfolio. So if it didn't do well, you still have that other 90% that's going to be fine. But it allows you, and again, there's funds out there that will target almost any different thing. It might be oil, might be energy, might be hotels. So you find those funds that would do it, or you go out and find those individual stocks yourselves and do it like that.
So you can then pursue a rational, objective, safe strategy. And at the same time, if you have an itch for a particular segment of the market, you can still allocate a little more funds to that, but do it in a more orderly way than through Robinhood or Schwab Online. So I really like the idea of financial planners, and people who listen to this show know that I'm a big fan of financial planners. I think they're grossly underused, and people will have all these other professionals in their lives, but it seems like 7 out of 10 people that I come across do not have any quote-unquote financial planner. If I ask them about who handles their finances in that way, usually they give me the name of an insurance guy and a stockbroker, and that's kind of maybe an accountant. But those 3 roles are not a financial planner that sits down in a comprehensive way and plans for the balance of your life. When we talk about this in the show, as I'm fond of saying, we get no financial support, we give no financial support to anybody that's on this show. And the things we say as a result are uncluttered by relationships like that. So whenever I recommend somebody such as Todd or people in that industry, it's for no other reason than that I'm a true believer. So Todd, we love having you on the show. You're always full of information. And we look forward to having you on in the future, assuming that you're available.
All right. I would love to come back. I'm going to head toward the East End and get my plasma taken now.
Make sure they give you some good cookies and juice afterwards.
All right, Joe. You all have a great day.
Yeah, take care.
Hey, remember, the world's full of good people. If you can't find one, be one.
Good advice. I need your optimism.
All right. See you guys.
Yeah. This has been another episode of Elder Talk. Till next week, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.